I want to give a nuanced answer.
Oh, yeah.
I know the nuance will be lost. I know the number will be. I'll give it an 8.
8.
And I think it's a global liquidity bubble. I don't think it's local or constant. It does concentrate towards us because people are looking for risk assets.
Right.
But that said, the tech industry is going through a marvelous phase where we are now attacking every industry, reaching every consumer or user on the planet.
Half of them.
Yeah, or half of them. There's soon to be all of them. And it's really the story of human productivity growth and GDP growth comes from technology.
Okay.
So I don't think Silicon Valley's going to
That was cheerleading. Did you hear it?
Or take a huge hit. I think
we're going to change the world. Great jobs.
Well, and it's incredible what's going on in China and India and internationally in terms of technology growth and adoption. So I think overall that is all healthy and positive. I just think that many of the central banks are still printing huge amounts of money. That money's trying to find a home in return.
Okay, that's not a tech bubble.
No, it's a global liquidity bubble.
Okay.
Well,
yeah.
Well, yeah, the heat just went up. Yeah, so I'd give it an 8, but I don't think it's concentrated with us. Unfortunately, I think every asset class is vulnerable right now to a big downturn.
Okay, but then we don't have to outrun the bear, we just have to outrun the other asset classes. Are we better or worse?
Maybe the bear eats all of us.
That's not good. How do I hedge venture capital?
You don't.
Okay. All right, with that bubbly sentiment, 8. Okay, 8. Going up or going down?
The trend on these things is they go up till they go down.
Okay.
It's the nature of the beast.
All right, you got 2 more notches before it gets a little
It's basically a one-way ratchet.
Don't use that word. All right, so how's Angelus doing and what's latest stats for you?
We're doing our thing. We're still doing syndicates for the online fundraising. Probably now at around 16, 15 million a month moved online.
Okay. That's through syndicates or
through syndicates?
Through syndicates,
yeah.
Okay.
And it's about 30 to 40 companies getting financed every month online.
So that's effectively 200 million annual growth.
Yeah.
That's the size of a pretty decent venture capital fund.
It's the equivalent of about an $800 million to $1 billion VC fund,
right?
But concentrated entirely on seed investing.
Should any of us be worried? Anybody be honest?
I think everyone should be worried about it. Generalized fears are always.
I always ask you: are you displacing venture capital, or are you complementing venture capital?
At least so far, we're creating a lot more companies at the seed level for them to take from later.
Ah, so you're creating the Series A crunch.
There's too few at the A stage. I mean, the cost of building a startup has gone down, so the number of startups has gone up, so the number of investors must go up.
Okay.
That's just basic balancing the equation.
Do you think the quality of the talent is going up? Do you think the material we're investing in is better, worse, same?
It's really hard to say. I would say, like always, it's very distributed. There's good talent and bad talent.
Okay.
But overall, I think what's happening is a lot more people are getting into technology.
Right.
There's a lot more people taking coding lessons. There's a lot of people coming out of school with technical degrees. Okay. And Y Combinator, 500 startups were early magnets for that. But I think now the entire.
But all the rest of those guys suck. It's just us.
But now it's just a huge magnet. Anyone who has a tech degree is headed towards a tech center and is probably starting a startup rather than joining a big company.
I believe that. So you guys are doing a lot of things other than just syndicates.
Yeah, the talent side is actually bigger for us right now. So we have
Explain what is talent for you?
So we run this little Tinder-style matching service. It's free and it's open.
Tinder? What?
Yeah, where companies can meet candidates and candidates can meet investors. So there we do introductions, mutual introductions.
These are founders of companies.
Founders of companies reaching out to engineers, designers, marketers, salespeople. So we're now, we have about 9,000 companies recruiting on there, pretty actively.
Okay, that's a lot.
We have about 180,000, 190,000 candidates.
How many?
Yeah, it's a big pool. And
over 100,000.
Yes.
How many introductions? How many swipe rights? Is that it?
It's mutual.
I'm kind of clueless about Tinder.
Sure.
I don't know about the rest of you. I'm sure you're all on Tinder.
It's about I think the last week was 11,000 mutual introductions.
You're doing over 10,000 introductions
every week.
A week?
Yeah, doing candidates and startups.
I think a lot of recruiters in the room should be nervous.
Yeah, it's probably around 200 hires a week right now.
Okay. But you're not charging for monetizing this? Why not?
We played with some monetization on the margin. It's not a priority.
Okay.
Hey, it's a bubble. Why not?
Okay then. Interesting. Does that make you a competitor to LinkedIn?
LinkedIn seems to have a very different model. First of all, LinkedIn serves
That was yes. Did you hear that? That was yes.
LinkedIn serves the entire universe, not just startups. And they have a recruiter-based model.
Okay.
And they kind of work more with bigger companies. We're more with like small startups, 1 to 10 people, hiring their first few engineers, hiring their first few designers. Sort of after your personal network taps out. That's where we come in.
I think at the NVCA event recently, you mentioned that you haven't figured it all out yet, and you're still experimenting.
I'll probably always give that answer.
Yeah, I know that. But syndicates is working. You have a model there you're comfortable with?
Yes, although we rolled out this thing called funded backers where people put money in the cloud and have a 5-day opt-out. So it helps us do much faster closings.
So you're giving additional options for people to raise money, but syndicates is still primary vehicle?
Yeah, we're also now doing secondaries. We're trialing powering funds. So we're playing. Yeah, we're playing around with a lot of things. We're doing a lot of pro ratas. A bunch of VCs have started using syndicates to do private pro ratas of their LPs.
Okay.
So later stage deals where they have more.
Sounds like more of a second market type of platform.
Yeah, I don't really draw analogies. I think it's more just bringing more of the venture capital investing process online, making it efficient, smoother, more liquid.
So to the extent that you're providing some form of liquidity there, would that be a service you charge for or not?
Yeah, we'll figure it out.
This is a cagey bastard up here. You won't answer this question.
No, I honestly don't know. If anyone wants to pay me, they can. I'll put up a Bitcoin address.
I know you guys have been expanding a little bit internationally. You have UK up.
Yeah, we have a person in the UK. We have one person in Berlin.
Right. Yes, I know that person.
Yeah, we have 4 people in New York, so that counts as international. And we're trying to get regulatory clearance in Canada, Australia, and other places.
Okay. Any other place in Asia?
Asia is tough.
Yeah.
Yeah, it's just different.
I hear there's a lot of people in Asia.
Yeah, I hear that too. I've been to Asia.
Yeah. Yes, indeed.
Well,
we have.
like China is really interesting. What's going on there it seems very intense and very large.
That
very active.
seems extremely bubbly right now. Like, definitely long-term bullish on China, but crazy.
I was surprised to find out that seed valuations, and this is total hearsay, I haven't seen it myself, but at least the impression I got, you can maybe confirm this, is that pre-money valuations for startups, raw startups in China, are considerably higher right now
Much
than
higher.
in the US.
Yes. Yeah, Ray, she's in the audience somewhere, can attest to that.
Yeah, we're becoming the core. They seem to be going through their version of 1999
feels like
plus
late 90s.
2014 all rolled into one.
Yeah. Well, there's a ton of opportunity.
Yeah,
and
2014 in the
amazing
sense that
folks.
there is a real opportunity, but 1999 that there's incredible momentum too.
Good time to raise money in China, perhaps. So you have deployment.
Yeah, I think that part of the opportunity is normally, if you look at something like the oil market, it's like a global market. You can't have sustained higher price in one area than another. Obviously, startups and private investing. The startups and investing don't work that way because you can have very local, different prices. But I think even that's going to start changing.
I would think that Chinese investors might start looking to place money in other markets, but that's still mostly been big folks, not individuals.
Yeah, it's there's a lot of friction in the process.
So that might change a lot. There's definitely lots of other Chinese investments in real estate, and lots of kids who are going to school over here, even at grade school levels.
Yeah, I think the tough part for a lot of people is that a lot of the wealth creation is now moving to private markets.
Yeah.
By the time it gets public, because no one wants to go public with Starbucks, a lot of the value creation has already been done. So how do you give people access to that wealth creation at the private level?
So what do you think about that? I mean, we've had a lot of conversations, even last year. I think Scott Cooper and Mark Suster talked about that. The late stage part of the market has been moving more private. Companies could have gone public now or remaining private for many years.
Yeah, and most good companies don't want to go public. Especially in the tech industry, you're always under pressure. You're always being attacked by new entrants.
Assuming valuations and multiples are as good as the public market.
Yeah, if you can raise billions of dollars in the private markets, why not stay private?
Right. And some people are now suggesting that basically, used to be that non-public companies were lower multiples, now they might actually be higher multiples. At least
Yeah,
using
that's
liquidation
that's
preference.
obviously quite bubbly.
Yeah, right. But I mean,
but
that's
that
what
said,
I'm
it's,
saying.
it's because they're not buying common stock. There's liquidation preferences.
Yes.
Sometimes there's warrants, so
Right.
you don't know what's going on.
Valuation in private market not quite the same as in a public market.
Yeah, and there are definitely founders who will take a larger headline valuation just to put a big number up to then
So they can be a unicorn.
Yeah. Well, it gives them supposedly an edge in hiring, but I would hope that any smart employee candidate would want to dig in on that.
Do you think that that's true? I don't.
Yeah, it's not. I mean, if you're an engineer joining a large company, it's highly unlikely they're going to give you the lick pref stack.
Or even know what the hell you just said.
Yeah, the liquidation preference stack, like how much money they have to pay back to their investors before the common stock
Right.
can make a share.
I don't think that even most well-educated, thoughtful, smart people who work for startups, I don't think understand that at all. They're just like, oh, are they a unicorn?
Yeah.
Have they raised a lot of money? Great, I'm working for a company that's valued at over $1 billion. Yay!
Yeah, the problem is by the time it's a unicorn, firstly, you're only making money on the delta between it being a unicorn
Right.
and the exit, so that value
That's
is already
not
gone.
great.
Right, and then you have to pay back the investors probably several hundreds of millions of dollars before your stock's worth anything.
Right.
So in a downturn scenario, you can get hit really hard.
And so if there isn't a liquid market for common stock, or your CEO like Travis is absolutely adamant that none of that happens.
I mean, in the case of Uber, it's a little different in that they just generate gobs of cash flow.
Right.
I mean,
That
they
was-
spend it
that
back
was
into
probably
marketing,
fun.
but yeah.
So if I took a pool of unicorns in a particular vertical and I made an index bet on them, do you think that's a good bet?
It's a good question. I mean, on the one hand, you could argue the unicorns are, as a class, inflated. There's definitely been more price inflation in the later stage than the early stage. Early stage valuations are probably up 1.5, so call it 50 to 100%. So almost double from when we started in 2006, 2007. But they've been relatively stable or even down from 2011, 2012.
Right.
It's the later stage valuations that have really accelerated. They're up 3x, 5x.
Right.
That said, I'm sure you've seen the stat, you add all the unicorns together and it's worth less than Facebook or worth less than Microsoft.
Right.
So that's kind of a counter way to look at it.
So
you have Slack and Uber and,
Right.
and Airbnb.
Well, I think my point was, if you collected a pool of 10 food delivery startups,
Right.
7 might be overpriced,
Right.
2 might be correctly priced, and 1's probably underpriced. But you don't know which one.
Yeah, if you collected 10 food delivery startups, you probably have 5% of the food delivery startups.
Yeah. I'm sorry, if you had 500 food delivery startups, hey, that's an interesting name for fun.
You wanted a quote.
Hey, we have several food delivery startups and we use a lot of their products.
I mean, I
they're
love
very
it.
tasty.
Yeah, they're great companies, and I actually think some of them will turn out to be great investments.
Yeah, Yemek Fethi in Turkey was just bought for, I think, close to $1 billion by Delivery Hero. Sure. Yeah.
Yeah.
People eat food. Yeah, that happens.